Hello, this is Christina Severson, Learning and Development Specialist at Premia. I am pleased to welcome you to the webinar, Risk Management and FinTech Innovation. We have here today Graham Seal that will share his knowledge with Premia members. He has over 30 years of experience implementing innovative technology solutions to banking problems. During that time, he has developed a number of effective risk management processes and methodologies and formed the first IT risk management group at Bank of America. Graham consults with banks and fintech companies, enabling them to create partnerships that will resolve real bank business problems sustainably and with acceptable operational, credit, market, and regulatory risk. A few housekeeping items to get us started. In the panel on the right side of your screen, you will find control features, including the questions box. You may submit questions using this box at any time during the presentation. Graham will answer as many questions as time allows. We will try to leave a period of time at the end of the webinar for any questions that come in. Today's session will have poll questions dispersed throughout the presentation. The question and answers will be read to you. Do not submit your answer in the questions pane. Once the poll is launched, you will have 30 seconds to select your answer on the screen and click Submit. There is no grading on the answer. This is for continuing education tracking purposes only. If you require CPE or CFA credit, you must answer all of the poll questions and you must email webinars@premia.org to request documentation. We hope you enjoy today's webinar. At this time, I will turn the presentation over to Graham.
Thank you, Christina. Yes, I'm Graham Seal. It is a great pleasure to be with you all, speaking to Premia members about a topic that I think is becoming more and more important to any risk manager. I'm not a professional risk manager, but I've been a risk manager for more than 30 years because I've been in banking, and every banker is a risk manager. Christina, let's go back, if we could, to the agenda, and I'll just talk through what we're planning to present. Look,
it's just taking a little while to play catch up there.
Okay, that's fine. So I want to talk a bit about the relationship between fintech and banking, whatever fintech is, and we'll talk about that a little bit too. The key thing that every bank needs to understand, which is that fintechs typically do not understand risk. They don't understand risk management. So what do we do about that? How can banks and fintechs work together, and what role does risk management play? And I believe it's a very significant and important role that may be significantly underestimated in a lot of banks. Fintech also is not risk management's enemy, but can be its friend, and then lastly wrapping up with some best practices. So let's start out with a poll.
It's just taking a little while for it to catch up. It's almost there. There you go. Sorry about that.
That's okay. First question, do you see fintech as a threat to your financial institution's risk profile? Just yes or no.
All right, I am going to launch the poll. You have 30 seconds. You should be able to see it on your screen now. Closing the poll.
Interesting results. So a little under half of you do see fintech as a threat, and a little under half do not. And I'm actually a little surprised by that. I think most people see fintech as a threat, not necessarily competitively, but certainly introducing some new elements of risk to the institution. So we'll talk about what some of that is. Let's move on to the next slide. And we'll talk about how FinTech has been evolving. And indeed what it is, what we mean by FinTech, because there's quite a few definitions. A lot of people, when they're talking about FinTech, are thinking about alternative lenders or challenger banks or organizations that are disintermediating the banks by providing payment services, for example. And they're, in other words, disruptive competitors. Others would say, no, it goes beyond that. FinTech is also providing some alternative ways of banking that work hand in hand with how banks are working. And examples of that would be, again, alternative lenders who are providing lending services to parts of the community that the banks really can't reach for cost reasons or technology reasons or whatever, and that the two actually can work together. And then there are those who would say, and I'm one of them, who would say it goes way beyond that as well. And that FinTech is, as its name suggests, financial technology. It's simply an enabler to the overall financial services system, be it banking, insurance in particular, and that it can take many forms. Another way of looking at it is, are they partners to banks? Are they enablers of banks? Are they organizations that will transform banking? So again, partners could be alternative lending channels. There can be a lot of cross-selling, cross-border payments providers that are improving payments capabilities, and so on. The enablers are the software companies. That would include companies that are making it possible for banks to do advanced analytics with their huge amounts of data, companies that provide niche product additions that improve a bank's mobile offerings. It would include RegTech, regulatory technology, which we'll talk about a little bit later on, since obviously that's relevant. It might include areas like supply chain finance, which banks typically have not done very well, and also financial enablement of the supply chain, payments management, receivables management, which again banks have not done terribly well, especially for small businesses. So there's a whole number of areas in which banking is enabled to be more effective for its customer base. And then there are the transformers that are talked about a huge amount at the moment. We will come back to some of these. Blockchain is the obvious one that's top of mind, that is king of the hype cycle right now, but there's something real there, as is typically the case. Artificial intelligence, which means an awful lot of different things, but it's an enabler of new ways of banking, not just doing what we do today a little more intelligently or a little more efficiently, but doing things that we have never thought of doing before, particularly in an advisory capacity and so on. And then biometrics and a number of areas around cybersecurity that are enabling us to look differently at how we know our customers. Obviously bleeds into areas like KYC, where banks have to know their customers, not just from a regulatory perspective, but also from a security perspective, to be sure that they're dealing with who they think they're dealing with. Let's go on to the relationship between FIs and FinTech. And it's what I call an unstable symbiosis. So they need one another. And I'm thinking again with FinTech in its broader definition. This is where the FinTech is any company that is looking to work with a bank, either as a partner or as a supplier, an enabler, a transformer, whatever it is, but where there is some relationship between the FI and the FinTech. Not so much talking about the competitive relationship, because quite honestly, those are diminishing. Even the alternative lenders are starting to try to partner with banks because they realize there are things that banks have that they don't. Banks have, above all, trust. That trust gets eroded from time to time. Wells Fargo have experienced that recently. Many banks have experienced that. They get something wrong, and trust is eroded a little. But the banking system as a whole, which was built up on trust, still in most consumers' and businesses' eyes, maintains a great deal more trust in the technology industry when it comes to managing money on their behalf or managing risk on their behalf. So that trust is something that is really difficult for a fintech to build up. And many of them, even the very big ones, are finding that. And they're finding it goes away extremely quickly as well. Secondly, the fintechs who have tried to go it alone have discovered that it's very hard for them to scale. They can build an initial customer base of the early adopters and the innovative among consumers especially. Businesses are more difficult for them to work with, and there's a limit to that. And they look at banks and they see this huge customer base that a bank has, and they think, well, what if we can get a piece of that by selling things to them that the banks don't want to sell to them? And that's a lot of what we're seeing now in a number of spaces, lending, payments, advisory, and so on. The third thing that the banks have is capital. Now, the capital is under attack, it might seem, and obviously there's tremendous regulatory pressure to use capital wisely. But the fintechs just don't have it. And so investment is difficult for them. If any of you have been involved in financial technology startups, you know how huge a struggle cash is, how difficult it is to get funding, how long it takes, and so on. And then you see that the income stream doesn't come as fast as you thought it was going to, not least because banks, at least, are very hard to sell into. And so capital becomes a huge problem. And the last thing, obviously, is regulatory acumen. And I don't just mean knowing the regulations. I mean the mindset and understanding what regulators are looking for, why we have regulation, why it is, in principle, a good thing, even though it becomes very burdensome. And that's a mindset that fintechs just simply don't have. On the other hand, banks have really struggled with becoming innovative, with transforming themselves. They struggle with a culture that is very cautious and not just risk managed, but in many cases risk averse, which I think you all agree is not what risk management is about. And so it has made them slow and ponderous in a lot of ways. And fintech companies, if they have one thing, it's technical agility. They can make changes quickly, they can develop ideas quickly. They are often extremely strong technically and very good in the use of agile development techniques and so on. They also, by their nature, are creative. The fintech started because of somebody's creative idea. It may be the initial entrepreneur, it may be somebody who engaged an entrepreneur who is very creative, but they have ideas. They're seeing things from a different perspective and through a different lens. They can focus on point solutions in a lot of cases, where banks need to be very holistic in their use of technology. And there are times for banks when a point solution is just what's needed, but very difficult to develop internally. And FIs can really benefit from using a fintech solution to a particular problem. And then lastly, fintechs have a completely different risk profile, of course. They can experiment, they can try things. If they go wrong, the worst that's going to happen is the company will fail and the founders will go and start another one. And it's been surprisingly easy for people to do that. Now, obviously, they're not looking to fail. But the risk involved in trying something that you're not absolutely certain is going to work is quite different than it is for a bank. And so, so in some ways, banks can use the fintechs as ways for themselves to experiment. Quite valuable. Let's look more specifically at fintechs and risk management. And I made the comment earlier on that one of the fundamental challenges that we have as bankers is that fintechs typically do not understand risk. Christina, slide is not advancing by the look of it. There we go. All right. This is a fundamental challenge because fintechs don't know how to talk to banks. They simply don't know how to do it. Bankers often don't know how to talk to fintech companies. So there'll often be technologist to technologist conversations between banks and fintechs that bypass this issue until it comes time to actually strike a deal and start doing a proof of concept or something. And then both sides discover that they've really they've had an incomplete conversation. So, first of all, from a product set point of view, from most fintech CEOs, I would say, think that banks are in the business of managing money. And it seems to be a common sense statement. We all know that that's not true, and that banks are in the business of managing risk. They're managing risk, obviously, on their own behalf, but they're managing risk on their customers' behalf. The reason I put money into a deposit account is because it's safer there than it is under the mattress. It's a risk management technique for me. And not only that, I expect the bank to invest it securely so that parts of it I have almost no risk with a relatively little return, and other parts I can take on some risk and get an appropriate return, but know there's expertise going into it. It's all about managing risk, and fintechs need to understand that. I actually wrote a blog piece. If you're interested, you can look at my LinkedIn site. It's back a little way, called "What Every Fintech CEO Should Know About Risk Management," and it starts with this change of perspective, and then it just gives an overview of risk management for them. Regulation, obviously, banks are held to a much higher standard than fintechs. Not just in terms of specific regulations, which I think fintechs find easier to understand. They know about KYC, for example, but also the pressures that come from being regularly and routinely examined by regulators, the pressures of regulatory reporting, and so on. And so any solution that's introduced to a banking environment is going to have a risk management element and a regulatory element to it that the fintech company doesn't necessarily understand. Change management is another one where fintechs, they can fly by the seat of their pants to some degree. The best fintechs don't, and they have some discipline and they have some understanding of change management, but it's still pretty light. In banks, firstly because of the complexity of the bank and complexity of the organization and the culture, and then secondly because of all of the different parts of the business that need to be taken into account. Change management is a complex and critical function, and it seems very slow to a fintech. And then I really alluded to this next one earlier on, the risk appetite. Fintechs can afford to try and fail. Banks can't, and at least not without understanding the limits of the risk that's being taken. Fintechs can bet it all. Banks clearly cannot. So there's ways in which financial institutions, and I would say particularly risk managers, can help with this. Education, and I mean broad industry education, and education certainly in dealing with particular fintech companies, setting expectations up front. This is going to take a while. There are some hoops we're going to have to go through that you may not understand. Let us help you understand why we're doing this, and you can help us to do a better job. Adapting to the fintech world. One of the things I've seen in banks sometimes is, for example, in third-party risk management, they have a one-size-fits-all approach. And so a vendor who wants to come in and do a proof of concept in the bank's environment, even in the developed environment, for a somewhat peripheral area, is put through the same kind of risk management routines that somebody who wants to come in and replace your payment system. And we need to adapt somewhat. And then, of course, the third thing is managing risk rather than taking a reactive response to it. So being proactive, how do we make this work within an understanding of what our credit risk and operational risk and indeed market risk and other forms of risk are going to be. And how do we ensure that we do this within our risk appetite? Let's go to the next polling question. So is your organization actively engaged today in FinTech initiatives? Three-part answer, this one. Yes, we're already implementing FinTech solutions. Secondly, we're exploring FinTech solutions and partnerships. And thirdly, no, we're not.
All right, I'm launching poll question number 2.
Okay.
All right, closing the poll. Here are the results.
Right, thank you. Yeah, that's pretty much what I would have expected. That FinTech is finding its way into particularly most of the larger banks, smaller banks less so, and there's a lot of exploration going on right now. So thank you, yeah, that was helpful. Let's move to the next slide and talk about risk management's role with FinTech. So where do you fit in? And we'll talk a little later about how you make sure that you do get to fit in, because that can be a challenge. But regardless of the relationship and what it looks like, even if FinTech is seen as a competitor, there is a risk management engagement in this. If FinTech is taking customers away, obviously there's a risk to the bottom line. And a form of operational risk around the impact on profitability. But also, if, for example, alternative lenders are taking away particular kinds of credit, what's this doing to our credit portfolio? Is it increasing concentration risk and so on? And if FinTech providers are getting involved in spaces that regulators prevent us from getting involved in, is there a need, in fact, to get some regulatory relief, some regulatory change? The recent initiative to give partial banking licenses to standalone FinTech providers is an interesting response to that. Of course, some FinTech providers are saying this is really good, we get to be a bank now, until they discover what's really happened is that the regulators have been smart and said, okay, we really can have a bit of control around you now, and no, you can't do anything more than you've already been doing. So there may be some rude surprises there. But we can get involved, and risk managers obviously have a lot of influence with regulators and with the regulatory community. If the FinTech is a partner, it's the nature of the operational risk is going to be important. If they're a partner, we may be cross-referring, we may be outsourcing certain functions to them, and obviously the significant third-party risk management there, significant operational risk in general, which we need to look at. And there's always a question of who is really responsible for meeting regulatory requirements. I come across this quite a bit, especially in the payment space, and particularly around KYC and sanctions and so on, that the FinTech will disclaim all responsibility for regulatory compliance. But the bank will not have sufficient control and information to be able to do it. And so those things really need to be worked out, and the product managers and technology managers really need your help to work that through. And then lastly, of course, if FinTech is a vendor or a partner who is providing solutions to be run within the bank's auspices, then it's standard third-party risk. And the standard technology risk management overall, cybersecurity and everything else, and product risk. So you would treat this like any vendor relationship, really, and give it a holistic look. But clearly, whatever the role is that FinTech is playing, risk management is absolutely critical if this initiative is going to be successful. So with that in mind, let's go to the third poll question. And the question is, at what stage in a development initiative, in a solution initiative, does your organization engage risk management? Are you engaged from the very beginning, from the problem definition stage? Are you engaged after a solution has been selected but before implementation starts? Or are you engaged, it may sometimes seem like an afterthought, during the solution implementation? And it may not be exactly any of those three, but select the one that you would say is nearest for the organization that you work with.
Launching the poll question. Okay, closing the poll. Here are the results.
Yeah, again, probably what I would have expected. And I'm glad to see such a high percentage engaged from the beginning. I would say most banks now have figured out they do need to engage risk management at the beginning of a change initiative. Risk management, I haven't seen quite as much as that involved in the early stages of determining how to address a business problem, and defining a problem and looking for potential solutions. I've seen them a little more often engaged when the solution provider has been selected, and then whoever's actually running it, the product management group or technology group, realize at that point they really need to engage risk management. But it is certainly disturbing that there's still 20% of you see yourselves being engaged not until the solution is being implemented, after the beginning of the project. And that, of course, you know very well, can create a number of problems. Let's move to the next slide. And this is what we're going to put up in a moment. This is a model that I use in working with banks and fintech companies and talking about their relationship and the things that go on, and the stages of verification that the solution really is solving the problem, and it's solving it in a safe and secure way. So this chart actually, the rows, the top is the phase, which are verification phases, and then their purpose. The buyer, the bank, has requirements that they need to satisfy, and you're part of that. And then the seller has requirements they need to satisfy, and there is a gap most times. And the reason that I created this chart is that I tried to fill that gap. But that's not the point of showing it here. I think in many ways you fill some of that gap. You're in a position to be able to be the communicator between buyer and seller when it comes to risk management. Sometimes you all know very well that not every banker understands risk management the same way. Some understand it very well, some do not. Not every technologist understands risk management, particularly beyond technology risk. And so they need your help in translating that. And I think a key thing is understanding what is and is not being proven at each stage. So when the problem solution set is being described and we're in what we might call PowerPoint mode, and chatting about how a solution might address a problem, risk management certainly should be involved in this stage, because it's possible very early on to identify that there are some things that need to be done to make this work. And then the supplier may provide a prototype, which of course is not real production. It's just something that is anything from a mock-up to a limited working model that is a demonstration of the solution they have for the business problem, allows the bank to say, yeah, that's kind of what we're looking for. And then they would go into a proof of concept. And here there are very clear goals to be satisfied there are certain things that can be addressed in the proof of concept. And there can be an opportunity to introduce some risk elements here too. If we want to demonstrate, for example, that the solution works, but it doesn't create a particular kind of problem, then we can test for that in a proof of concept. It can be designed that way. And your guidance is really critical in designing a proof of concept. Once you get into pilot, and obviously a big gap potentially between proof of concept and pilot, where all the development is going on and all the aspects of change management, a pilot is used to manage the risk around the rollout of what is potentially a complex and potentially error-prone solution if something's been misunderstood or if testing has been less than perfect. And so your engagement in the pilot, in defining what the risk is and in managing the risk around the choice of pilot customers, the scope of what's being rolled out to those pilot customers, that also is very important. And obviously you're engaged on a day-to-day basis as risk managers in production. And it doesn't really matter what area of risk you're particularly focused on. This is really obvious for operational risk, but obviously there are elements of this apply credit risk, market risk, and so on, and particularly in regulatory risk. So it's just a way of demonstrating that I think you need to be part of that glue that brings together the bank and the fintech from a risk perspective from the very beginning. And I would encourage you to agitate for that if that's not happening today. And I'm glad that for a number of you it is. I'd like to just look at fintech as the risk manager's friend. And it's easy to look at risk at fintech as something dangerous, something that is introducing new kinds of risk. In a lot of cases, fintech companies are very small. They may have a dozen people. How do we manage that risk? Also, it's easy to look at other kinds of fintech as competitors to banks, and so being bad for risk and bad to the bank in general. But I think there are a couple of ways in which fintech is quite exciting in the risk management world. The first is the new specialization called RegTech, regulatory technology. A number of people I've noticed in their predictions for 2017 have said 2017 is going to be the year for RegTech. Whether that's true or not, I don't know. But it's clear that regulatory spending or spending on innovation and technology for regulatory compliance purposes is higher than it's ever been. It's clear that banks are putting a significantly higher portion of their new technology budgets toward regulation and risk management. That's why you're in the right place at the right time, and you get to be a part of spending that money, which is really good. RegTech it's really growing. There are I think now probably hundreds of RegTech companies around the world. That's still relatively small. There's tens of thousands of fintech companies overall scattered around the world. But RegTech is growing really fast. And so there's a number of different ways in which they can help. You look at something like KYC, AML monitoring, fairly obvious. Companies like Trulio, who help with ID verification, Trunomi, who help with the use of customer data on a consent basis. Company like IdentityMind around fraud and sanctions and so on. A small company called Amberoon, which uses machine learning and advanced analytics to drive out a risk-based approach to AML monitoring, which the rule-based systems simply can't do. And so on. And so using new technology techniques and again being able to use their agility to develop solutions that the big technology companies even are not able to do. The introduction of online control frameworks, for example, there's a company in Germany called Align who have built a very comprehensive cybersecurity compliance framework and methodologies that are web-driven for rolling out the framework, ensuring compliance, providing an immediately accessible documentation library and so on, and being able to measure compliance based upon, particularly around training and that kind of thing. That's not high technology, but it's using technology capabilities and a real focus on a particular problem to develop solutions. Regulatory reporting, there's always been a lot of technology around regulatory reporting, but it gets more difficult, of course, and there are new players coming into the frame who are using newer technologies, newer insights that I think will start to become relevant. Risk data warehouses, and so on. There's many things. There's a lot of there's a bleed between RegTech and risk management, since obviously a lot of the work you're doing around risk management, even if you're not in a regulatory compliance area, is feeding regulatory reporting. The analytics that you're doing are feeding the ability to provide reports. And so fintechs are also providing help in the risk management area. The obvious one, new forms of credit underwriting. It remains to be seen how helpful they really are. We don't have any history around, for example, social credit underwriting. Is it going to, in a stable, relatively up-credited environment like we have today, it looks just fine. What will it look like in a downturn? What will it look like when things get a bit volatile? What would it look like when particular geographic and industrial sectors start taking hits? And so the jury's still out. But the fact is that there are new approaches to credit underwriting becoming possible, and certainly the ability to use new forms of data in addition to what's already being done, and do that without having to introduce a whole lot of additional effort. Risk quantification and obviously a lot of focus around big data analytics, data intelligence, and so on, to drive risk quantification, not just in the traditional areas of market risk and credit risk, but also at operational risk that has always been hard to quantify. That's when I was doing IT risk, that's something I got very frustrated by, actually, and my one patent was in the area of trying to quantify operational risk around technology. I think it's still a big problem. And so we'll see some technology help in addressing that. And artificial intelligence will come into play there as well. It's never going to be a substitute for the risk manager. It is going to be a tool that helps the risk manager be more effective. Market logistics is an interesting one. It may not be immediately obvious why that's a risk management help, but the fact is there is tremendous risk around the way in which transactions flow today. So transaction processing in general, be it securities trading or payments or loan processing flows or whatever. The introduction of new technologies, and the obvious one is blockchain, in a number of those areas, will allow some tightening up, improved cybersecurity, improved non-repudiability of transactions, will make fraud more difficult. It is going to take longer than everybody has been saying it's going to take. That probably doesn't come as a big surprise to you, because you know a lot of the reasons for that. But there are a lot of opportunities that eventually we will see the benefit of, and which will help with managing risk. So in some cases it will result in actual reduction of risk. In other cases it will help us to understand risk sufficiently to be able to make appropriate decisions about mitigation, remediation, transfer, or avoidance. Let's move to best practices. These are kind of touchy-feely. I don't want to give you specific processes that tell you how to do your jobs. You don't need that. But I think there are some things to keep in the back of your mind, which in the heat of battle sometimes you feel like you don't have time for, or they get to be difficult. Staying in touch is really important. You are going to have people in the organization come to you and say, we have this fantastic FinTech solution, and it does this, this, and this, and it uses this technology and that technology. What do you think about it from a risk management perspective? And you don't have to play catch up from the very beginning when that conversation starts. Obviously, they're not going to expect you to have all the answers right away. At least they shouldn't. But keeping up is going to make it easier to know what might be coming. So part of that is listening for what's going on in the organization, watching the announcements. Some banks are better at announcing publicly than they are at announcing internally what's going on. So sometimes you actually have to watch your company's press releases. Following FinTech developments in the industry, particularly areas like RegTech or risk management technologies that you may be able to use and that you may be able to champion within your organization. This is the time to do it when there are, in most banks, significant budgets for being able to do a better job with risk management overall. Get involved, find opportunities to be a part of the innovation team if your bank has one. Smaller banks typically don't, but larger banks in some cases have many innovation teams. Lines of business have their own innovation teams that sometimes seem to be competing with the overall innovation group in the bank. And I've certainly seen that in some of the biggest banks. And but get to be a part of it, get in on the ground floor through that, because a lot of the bigger innovation solutions are going to go through that innovation team one way or another. Also, if you're supporting a particular line of business, be a part of the conversation about how technology might come into play in addressing the biggest business problems. Even if they're not immediately, obviously, risk problems, of course, they all are to some degree or another, aren't they? And then the last one here, and I think this is really important, and some of you are already very good at this, and some of you are learning how to do this. But it's how do you become an enabler, not a roadblock? Sometimes you're under management pressure to ensure that we don't take on any more risk in a particular area, or that we don't do anything until at least we fully understand it. And you know that we never really fully understand a risk area. There's always something new. Cybersecurity, goodness knows how much we've spent on really sophisticated cybersecurity solutions, only to discover that the next day somebody's broken it, and so on. So be an enabler. What do I mean by that? I mean, when you become a part of a team as a risk manager, and people are looking to you to see how they can safely implement something that they're interested in doing. Your role is to sit down with them and say, yes, how can we make this work? Not, here are all the reasons this is a bad idea, or here are all the reasons this is going to be really, really difficult. But how do we make this work? And let's together develop an understanding of what the risk profile is for this initiative, of what the appropriate things are to do to manage that risk so that we have a successful solution that is still within the bank's risk appetite. And it's that balancing act that many of you do much better than I do, because you do this as professional risk managers. And that ultimately, I think, is your goal, isn't it? That's your role, is to enable ongoing operations and change within acceptable risk. That is the end of the slides. I don't know if we have any questions so far. I think we may have one or two, but please continue to post questions, and then if you would like to reach out to me afterwards, I'm very open to emails, or connect with me on LinkedIn by all means. I think the only Graham Seal on LinkedIn worldwide, so that makes it easier if you spell it right. And or give me a call. So what questions do we have, Christina?
Thank you, Graham. Okay, I have a few. The first question is, in your opinion, how long will it take for fintech companies to catch up with traditional banking with respect to adopting bank-like risk management processes and a typical CRO position?
Oh, I don't think they ever will. And the reason, it's a great question, and I'm taking this in the sense of fintech as a standalone entity. They may develop a CRO position, and obviously as they become more prone to regulation, are more focused on sustainability, ultimately they will morph into a financial services company. And they'll no longer really be predominantly a technology company, which is what they are today. And I know some banks are saying we're really a technology company that sells financial services, but forgive me, but I don't buy that. Banks are financial risk management companies that use technology enormously to serve all of their different lost the word. Anyway, who serve their customers and the regulators and their investors and everything else. And so fintech companies are going to have to also serve all of these different parties, and they are going to have to manage risk. But at that point, I think they become more focused on their existence as a financial services company than as a technology company. So perhaps a different way to answer your question is, I think that will happen when they become a financial services company. And that could be years, it could be shorter.
Okay, great. I have two more questions, and they kind of go hand in hand, so I'm going to read both of them first. If you don't currently see this happening, how can banks educate, guide younger fintech companies with respect to risk management and its importance to financial players? And then the other question kind of goes with this. I'm with a smaller financial institution and we would like to engage in fintech. What resources do you recommend for us to begin the process of identifying partnering organizations?
Yeah. Okay. I will take them separately. Both great questions. I think banks have a real opportunity to engage in just simply communicating within the fintech community a bit more than they do. I think in conferences and webinars and so on, I've done a couple of webinars, panels where I've tried to engage bankers along with technologists and risk managers and so on. And I always find it hardest to get the bankers to engage. And they will sometimes. But I think it's critical for the technology community as a whole that they get some education from banks. I also think that the banking associations can probably do a better job of engaging technology providers and providing services to them. Your cost is always an issue for a fintech company. They don't. You're asking them to pay a couple of $1,000s to join an association, and most associations charge them more than they charge banks. They simply can't do it, so they don't join, and they miss out on those opportunities. Finding ways that they can get some continuing education around banking as a whole, and particularly around risk management. And then lastly, ensuring that when you do engage with a fintech company, that risk management is part of the conversation. Set up that expectation right up front that you're expecting to be talking about risk management with them, not just about their product. And that you understand that they may not fully appreciate what your risk environment looks like, and that you'd like to share that with them so that you can all be successful. So I think it's a matter of being really proactive in the market and in individual relationships. Now, as far as the other question is concerned, it relates to risk management, but it also relates to smaller banks as a whole, community banks, credit unions, and so on. They are, even smaller regional banks sometimes struggle with how to get started. And so there are resources, this wasn't intended to be a commercial webinar, but I'm potentially one of those resources. It is one of the things I do is consult with community banks on engaging with FinTech. So please, by all means, reach out to me. There are also organizations that provide matchmaking services between banks and FinTech companies. An example is a company called Matchy.biz, MATCHI.biz. And you can just Google them. There are I think it depends on the situation, though. The key thing is to drive everything from the business strategy. If a bank sees a fancy new technology and thinks, yeah, that would be really cool to engage that, they're not going to be terribly successful. If the bank has an area of business strategy that needs to be enabled with technology, and we want to go out and find what is the best technology to engage it, which may be new, may not be new, that is the right way to go about it. And then you can use your consulting services, boutique consulting services, and matchmaking companies, and of course, some of your own research. But there isn't time to do all the research, so getting some help. I hope that helps with that question.
Great. And I have one last question. How well are the FinTech companies managing the cyber risk of their technology solutions?
That's a great question. I think they probably vary somewhat. They are mostly, in my experience, they're mostly pretty sophisticated from a technology perspective. And they do know the one area they're aware of that banks are going to be concerned about is cyber risk. So they do know that you're going to be looking at how, for example, non-public consumer information is going to be protected. You're going to be looking at their perimeter security if you're outsourcing to them, and so on. They know all the certifications they need, and so on. So at a technical level, I would say for the most part they're going to be pretty strong. Of course, you can't assume that, and you have to do your normal third-party due diligence around cybersecurity. But I think you'll find that for the most part will be a relatively straightforward conversation compared even with some of the more traditional vendors that you've had to deal with that have been in business forever and have had to catch up with cybersecurity the same way the banks have. Yeah, I think that's about it.
All right. I think that concludes the questions. Thank you, Graham, for sharing your expertise with our audience today. As you can see, his contact information is present on the screen. On behalf of Premia, we thank each of you for participating. A recording of this webinar and the slide deck will be available to sustaining members within the next 48 hours. Thank you very much.
Thanks very much.